Getting a precise and clean entry is one of the most important thing when trading this strategy. But another important thing is how you manage that trade once you get an entry. And a few things we're gonna look at in this video where we'll be talking about trade management is when to break even, when to put your stop loss in profit, when and where to compound, and when to exit a trade. Now, if you get a precise entry and you don't know how to manage that trade, then you can basically make nothing of that trade, right? Because you probably get that entry and you get stop out of the trade because you move your stop loss in profit too early, right? You didn't maximize on the profit because you came out of the trade too early, because you think the trade might retrace and take you out of the trade or whatever, right? Now, one of the best things to do, right, when you get that entry is take partials. So if you enter this trade with a 10 lot, right, and the trade reaches like say 50% or a comfortable profit, then you can take partial. You can close 50% of that trade, right? So let's get into it. So in this trade we got an entry here, right? Now if you're following structure, right, we had this breaker structure here on the 15-minute time frame, right? So from here to here. Now structure, the rules of structure is that market always retrace, and it can retrace to 50%, 80%, whatever the case may be, right? But in most circumstances it don't retrace to 100%, right? So if you look at the premium and discounted fib here, this is equilibrium, which is 50%, and this anywhere above the 50% is premium price. So anywhere in the premium price, that is where market will actually retrace. 50% are in the premium price. Now we got the entry here. So if you get an entry here, where will you break even, right? You cannot break even anywhere before this structure, right? Why? Because if this structure is the last lower low in the market, because we're going in a downtrend, right? So we have this lower low here. So we have a lower low here. So if this is a lower low, the market give you an entry here. Market can always play around here. Always play around your entry and then push down, right? So we call that a complex pullback. So we can always have complex pullback here. But once market create a new low, right? Once market create a new low, the most the market is supposed to come back to is premium price, right? Where you can come back to 80%, 90%, 50%, or whatever case may be. So once market break this structure here, this is when my stop loss will be in profit, right? So this is when my stop loss will be in profit, when market breaks structure. So I know that the market from this new low will basically create a new lower high to continue pushing down, and in most cases, as I said before, it's not going to go back to the 100% retracement, right? So this is when you put your stop loss in profit, when market create a new structure, right? Now where compounding and proper risk management is concerned, if you enter this trade risking 1% of your $10,000, right, which is $100, there is no way you can compound before the market break your first entry break even. So when the market break this area here and you break even your entry, which means that you're risking nothing on this first entry, that is when you can take a compound entry. So looking at this, right? So looking at this here, we have the market created some liquidity here, and then we have inefficiency here, right? So this could be a new entry. Short position tool here, and stop loss above inefficiency 1.2 pips, and extend to our initial take profit area, right? So this is another 1 to 27, so that's 1 to 27 plus, basically this was what, 1 to 50, 1 to 60, so 1 to 60 plus 1 to 27, right? Which would be 1 to whatever the case may be, because remember the first entry is at break even, so we're still risking only 1% on this trade. So if you had entered our compound before you had this at break even, that means you'd be risking 2%, because you have two 1% trade open, right? Because that would be 1% on this trade and 1% on this trade, which would make you risking 2%. So what if you lost this trade, market kick you out, and the market come back and kick you out up here as well? That would mean that you lost 2%, right? And it's only ideal to risk, if you're risking 1% on a trade, to only risk 1% per trade, right? If you're risking 2%, 2% per trade. So you're not going to be risking 2% here and 2% here. That's 4%, right? So yeah. And next thing is when to put your stop loss in profit. So we looked at when to put your stop loss at break even. Now we're going to look where to put your stop loss in profit. So if you're looking at this, remember the first lower low that was broken, we had stop loss at break even, because market can come back all the way to, let's say, 90% or 80%, 50%, whatever case may be, and then retrace. Now doing that, the market created a new low here when it broke this structure. So market created a new lower low here. So when market created this new lower low, right, the market, so it's right here, created this new lower low, the market is supposed to push up, create that new lower high, and then break structure. So once market push down and break this structure here to create a new lower low, that is when you put your stop loss in profit, right? So you can either put your stop loss in profit, or once the market reaches, say, a substantial amount that is okay with you, then you can also take partial, which is closing a percentage of that trade. Maybe you want to close 80% of the trade, 20% of the trade, right, or 50%, whichever the case may be, but you can close a percentage of the trade and let the rest run. So without even putting your stop loss in profit, you can still have your stop loss at break even, you close most of the trade and let the rest run. So even if the market comes back and kick you out, then it's fine, because you already went away with like 80%. So what taking partial also does, it also helps your psychology, right? Because if you're in this trade full margin and you start to see the market retrace, you're gonna start to say, oh, what should I do, close this trade or whatever. You forgot all about structure, everything, right? You're just looking at the profits. So when you take partials, you basically take a comfortable amount, right, of profits, and then your mind can be at ease while the rest run, right? So that also helps with your psychology, and we'll talk about that in the psychology video as well. Now you guys already know that where you exit the trade is like areas of liquidity. So we exit at POIs, like order blocks, equal lows. Just if you're looking at structure, we exit at a high, a low, a lower high, whatever the case may be, depending on the trend of the market. So if I was supposed to take an entry here, and I would have my target here based on this 15-minute time frame. I didn't say based on a high time frame. Based on the 15-minute time frame. If I'm just looking at the 15-minute time frame, I would be targeting this high, because I don't see an area of liquidity or order block or anything. So I target the high, because I know that the market is in an uptrend and it's supposed to create new highs, right? But in this case right here, we targeted this order block because the market is in an uptrend and this is a retracement, right? So this would be a point of interest to buy the market. So that is where we actually take profit and look for entries to buy as well. Now, another reason why most traders enter some good trades and actually lose that trade, right, is because they're managing their trade on the wrong time frames. You cannot manage a trade on an entry time frame, say the 1 minute, a 2 minute, or whatever the case may be, unless you understand structure to a level and know the correlation between the time frames, right? But let's look at this example here. This is the 15-minute time frame, right? And we see market pushing to the upside here, here, here. This didn't break structure here, so obviously this would be the new structure, right? Obviously that would be the new structure because this did not break structure, so this is just a complex pullback. So if we're looking at this, we know that the market is supposed to push back to at least discounted price for us to get an entry, right? And note the market came back here, so let's go on the 5-minute time frame. So the market came back here, the market came back to this inefficiency area, and then the market mitigated and pushed to the upside, right? Now that's one, but remember all of this is 15-minute structure, not 5-minute. These little retracement between here is 5-minute structure. So this is 5-minute structure, market push up, broke structure. This is 5-minute structure, 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 here again, and then here, right? So we see all of this, right? But remember, we're looking at the 15-minute time frame before. So this is the case now. So you got an entry here. This is a good trade, right? So you got this entry, precise, right? So you got a precise entry here with maybe a 2 pip stop or a 1 point something pip stop, whatever the case may be. You're targeting, let's say, this high over here. Right? So you have a nice 1 to 13, right? You have a nice 1 to 13. It might not look much on, say, a $100 account, but I mean, you have to start from somewhere, right? So you have a nice 1 to 13, and you got entry on the 5-minute time frame. You cannot manage the trade on the 5-minute time frame because that was just your entry time frame, right? So now you saw the market push up and you saw this break a structure here, and you're saying, oh, the market breaks structure here, so I am going to be at break even. Okay, so you put your stop loss at break even once the market broke this structure. Cool. Market push back down, it didn't take you out. Market push up, break this structure here again, and then the market push back down and then push up. So once you see this, now you're saying, all right, the market created this new high, so we're supposed to create new lower low. So here I am going to put my stop loss at this previous low because we're not supposed to come back to this area because we're trending up, right? Let me change the color of this. So this is your stop loss. So you move your stop loss and break even, and you put your stop loss in profit, right? But bear in mind, this 15-minute structure here has just been broken. This 15-minute structure has just been broken. So all of this trend is just a trend on the 5-minute time frame. What about the 15-minute trend? So the 15-minute trend should be looking something like this. So market came, market broke structure. So obviously the market is gonna come back to at least discounted price to continue that 15-minute trend. So this is it, right? So let's go on the 15-minute. So this is what the 15-minute is looking like, right? So you notice all of these trends that you were looking at is just 5-minute trend. So the 15-minute just broke structure and if it's gonna continue the uptrend, the 50-minute, you need to create that new higher low to continue the push to the upside, right? So boom, that's it. So you would have gotten stop out of this nice trade here just because you put your stop loss in profit too early, because you were managing the trade on a lower time frame. So that is a big issue. Persons managing trade on the wrong time frame. You have to know the time frame correlation, know when to move your stop loss at break even, know when to put your stop loss in profit based on the different time frames, right? Because we were looking at 50-minute structure, you got entry on 5-minute. there is no way you can manage a trade on the 5-minute time frame. All of this is just complex pullback to break 50-minute structure. So in order for this structure to break, it must be in an uptrend on the lower time frame, right? And then to get the retracement, the lower time frame will also be in a downtrend, right? So if you caught a sell here, you must know that you have to get out before the market reaches the discounted price, or get out within discounted price, because this is 50-minute uptrend, right? So you would have lost this nice trade because you managed the trade on a wrong time frame, right? So yeah guys, so that's it for trade management, and I'll see you guys in the next video, which will be the last video in this section of the course, where we'll talk about psychology, right? Basically reasons why persons fail at forex trading. So see you guys.